If you're building a UK startup, 2026 will reshape your entire tax landscape. Stay with me. The new corporation tax rules could affect your funding, profits, and long-term survival.
Hello and welcome. We're getting straight into some crucial intelligence today, prepared by the expert tax advisors at My Tax Accountant, one of the UK's most trusted accounting firms. They've put this whole briefing together because, well, there's a quiet change coming in 2026 that could cost your business thousands if you're not ready for it. So let's get into it. Right, let's start with just one number, 14%. It doesn't look like much, does it? But from April 2026, this one little figure represents a really fundamental shift in how your business gets tax relief on essential equipment, the stuff you buy every day. We're talking about everything from new laptops for your team all the way to the van you use for deliveries. And that leads to a really critical question for every single business owner watching right now. This new rate, it could be quietly putting the brakes on your company's growth. The key is understanding why. What's the government's strategy here? And more importantly, what can you do to adapt and maybe even turn it to your advantage? Our goal today is simple. We're here to cut through all the jargon and give you the clarity you need. By the end of this, you should be able to look ahead to 2026 with real confidence, ready to make the best possible decisions for your business. So, here's our roadmap. We'll start with a big picture, the 2026 tax shift. Then we'll get into the details of investing in your business and how you can fund your growth. After that, we'll untangle the really tricky bits of calculating your corporation tax, cover HMRC's tough new rules, and finish up with a practical action plan you can start using today. Okay, first up, the 2026 tax shift. You can think of this as a story of two parts. On the surface, everything looks stable, pretty predictable. But as we're about to see, underneath it all, the rules of the game are being completely rewritten. So the good news is that the main headline rates aren't going anywhere. The government has committed to capping the main corporation tax rate at 25% for this parliament, and the small profits rate is holding steady at 19%. That brings a really welcome sense of stability. But the real story, the bit that's actually going to impact your bottom line, is hidden away in the small print. The allowances, the reliefs, and all the rules that decide how much tax you actually pay. And that's where we're going next. All right, let's talk about investing in your business. This is where those hidden details really start to make a difference. We're talking about something called capital allowances. Now, in simple terms, this is just the main way the tax system lets you deduct the cost of your business assets from your profits. And for 2026, they're being, well, let's say rebalanced in a big way. So this is what that 14% was all about. The main rate of the writing down allowance is getting cut from 18% down to just 14%. What that actually means is that for a whole category of assets, you'll be claiming tax relief on them much, much more slowly. The impact here is pretty significant. It could now take an extra 7 years to fully write off the cost of some equipment. Now, this isn't an accident. It's a deliberate move by the government to push businesses towards big, rapid investments through other schemes, instead of slower upgrades. This is a point that catches a lot of people out, and it has a direct effect on your long-term cash flow. But it is not all bad news. To try and balance this out, the government has introduced a brand new 40% first-year allowance. This lets you deduct a massive 40% chunk of the cost of new equipment in the very same year you buy it. It's specifically designed to help those businesses that can't use the other big reliefs. Think about sole traders, partnerships, or maybe a company whose whole business is leasing assets out to others. This new allowance is for them. This table really lays out your three main options for 2026. It's basically your strategic toolkit for investment. You've got the Annual Investment Allowance, or AIA. That gives you 100% relief on your first £1 million of investment, and it's fantastic because it even covers secondhand assets. Then there's full expensing, an unlimited 100% relief for limited companies buying brand new kit, and finally, that new 40% allowance to fill in the gaps. Now, here's my tip. For most small businesses, like a little cafe in Manchester spending £50,000 on a new kitchen, that £1 million AIA is more than enough. But if you're a larger manufacturer in Birmingham investing millions in new machinery, you'll be looking at full expensing. Knowing which tool to use is absolutely vital. Okay, so that's how you invest. But what about getting the money to invest in the first place? Let's talk about funding. The government is also changing the rules to encourage more private investment into growing companies, which is fantastic news if you're an ambitious startup anywhere in the UK. And this is a big one. From April 2026, the amount of money a qualifying startup can raise through the popular Enterprise Investment Scheme, or IES, and venture capital trusts is going up, and not by a little bit. For most companies, the lifetime limit has doubled to £24 million. And for what they call knowledge-intensive companies, think deep tech or biotech firms, that limit has also doubled to a massive £40 million. This is basically a major injection of fuel for startups looking to scale up and compete on a global stage. However, there is a crucial catch on the other side of this. While companies can raise more money, the upfront income tax relief for the people who actually invest in these venture capital trusts is being cut from 30% down to 20%. This might just make it a little harder to attract investment because the immediate tax carrot for investors isn't quite as sweet as it used to be. It's a rebalancing act you absolutely need to be aware of if you're planning a fundraise. Right, let's shift gears and get into the numbers. Calculating your final corporation tax bill, it's not as simple as just taking your profit and multiplying it by a percentage. There are layers to this, and this next point is one that affects nearly every small business owner, especially if you have more than one venture. So stay with me on this one. So, as we saw earlier, the UK has this three-tier system. If your profits are up to £50,000, you pay the small profits rate of 19%. If they're over £250,000, you're on the main rate of 25%. What this chart really shows is that bit in the middle, the marginal relief band. Its whole job is to make sure that the jump from 19% to 25% is a smooth slope, not some sudden painful cliff edge that punishes you for growing. But there's a hidden rule here that can change this whole picture. Now, here's where most people get confused. It's called the Associated Companies Rule. And simply put, if you control more than one business, those 50,000 and 250,000 profit thresholds we just talked about, they get divided by the number of companies you have. This rule is there to stop people from splitting one big business into lots of smaller ones just to try and stay in that lower 19% tax bracket. This is incredibly important for serial entrepreneurs or even a freelancer in London who has their main limited company and a little side hustle that's also incorporated. It's a huge tripwire. And this slide just shows you how powerful that effect is. One company, your 19% tax rate goes all the way up to £50,000 of profit. Great. But have two associated companies. That threshold is sliced in half to just £25,000 for each of them. And if you control 4 companies, that threshold plummets to just £12,500 each. You can see just how quickly the benefit of that lower 19% rate completely vanishes. You could end up paying the 25% main rate far, far sooner than you ever expected. Okay, our final section before we get to the action plan. We need to talk about HMRC. Their approach to compliance is hardening, and they are getting much, much tougher on tax evasion. You'll definitely want to hear this part. This quote from tax industry experts really sums it up perfectly. HMRC is moving away from just handing out financial penalties. Now, they are far more willing to pursue criminal prosecution, especially for businesses that are traditionally cash-intensive. Think about your local high street, nail bars, car washes, takeaways, market stores. They are all firmly in HMRC's sights. And did you know this? HMRC is deploying 350 new specialist criminal investigators to form a brand new dedicated team. Their specific job is to tackle serious fraud and tax evasion by small businesses. This isn't some vague threat, it's a real statement of intent. Getting your books in perfect order is no longer just good practice, it's pretty much essential for your own protection. My tip here is simple: go digital. Using proper accounting software doesn't just make your life easier, it creates a clear, auditable trail that HMRC absolutely loves to see. So, with all of that in mind, the changes to allowances, the funding rules, that associated company trap, and HMRC's tougher stance, what should you actually be doing right now? Well, we've distilled it all down into a clear 3-step action plan to help you get prepared. So, what's the crucial takeaway from all this? It's simple. Be proactive, not reactive. First, review your company structure. Do you have any associated companies? You need to know exactly how that impacts your tax thresholds. Second, plan your investments strategically. Think carefully about when you buy new assets to make sure you're using the right relief at the right time to get the maximum benefit. And third, and this is the most important one, get expert advice. These changes are complicated, and a little bit of tailored guidance now can save you a huge amount of money and stress down the line. Now, before we finish, it's really important for us to state that this briefing is for general guidance only. Every business's situation is unique, so you absolutely should not rely on this information alone when making financial decisions. The best and safest thing to do is always to seek professional advice that's tailored to your specific circumstances. If you'd like to have a chat about how these changes will specifically affect your business, please do get in touch with the experts at My Tax Accountant.
All their contact details are on the screen for you right now. And for more essential updates just like this one, please make sure you subscribe to the My Tax Accountant channel. Thank you so much for watching.